I'm Scott Elliott with New Chapter Consulting. Welcome to Ownership Essentials, where we share the education and insights you need to make smart, confident decisions as a business owner. Now, one of the most vital parts of the ownership journey is funding, because the right capital strategy can mean the difference between constant stress and sustainable success. So in this video, I speak with franchise funding expert Al Lesko to break down what every aspiring owner should know about finding and securing proper funding. To kick things off, Al, a question. When someone first starts exploring franchise ownership, funding, it often feels like that's the biggest hurdle. From your perspective, what's the first thing people should know about funding a franchise?
In my opinion, before they should get too deep into looking for anything, they should know what are their funding capabilities and what options do they have of those. So that's your starting point. It doesn't make any sense, in my opinion, to start looking at things until you get that out of the way right away.
Yeah. So is it like with a mortgage, you go get a pre-approval, or what is it like? How's it different, or what's similar?
Okay, there's some similarities and some differences. Number one, there's more options as far as instead of a mortgage, you're going to a bank, specific bank for one particular thing. They're going to have their own rules and uh, policies that are going to be different from another bank. In this particular situation, you have options such as using your retirement account. You have your options as using SBA loans. You have personal loans or term loans, HELOCs, cash outs. There's all different types. You mentioned pre-qualifications. That's kind of a misnomer in this business. What there is a pre-screening, because no bank or any funding source will do anything without submitting your information, financial information, in a trust and verify.
Got it. So there's a step where you pre-screen to understand what's the likelihood that a person will be able to get funding. And then they know that, then they can go speak with franchisors. They know their investment range and they know what they're likely, though not guaranteed, to get approved for. And then once they've actually made a decision or deciding to commit to an investment, that's when they go through the formal process and actually get approved for one of these funding sources. Is that basically how I'm hearing it?
That's very good, a very accurate description. The answer to that really question is because it may sound like it's a step that may not be necessary. Maybe I'm not ready, but it would actually expedite a process as far as getting funded and moving through and getting the details you need to make a decision on whether or not this opportunity will work for you and how it's actually going to affect your budget.
That's a good point, Al. When I think about the franchisor's perspective, do they prefer talking to people who've been through that pre-screening process, or does it not really matter to them?
It absolutely does. I should tell you, my degree's in criminology, so I'm always looking over my shoulder. So when it comes to analyzing people or a little psychology, and it's the same thing with a franchisor. They're looking to see if you're going to be a good partner, not just if you're financially qualified. So with that being said, you're going to get more information from them that you need if you are able to supply them that you're legitimate, that you are serious, and you are financially qualified.
What does that pre-screening process look like? Is there a cost to it? How long does it take?
The cost to it, at least with our service, is we cover the cost as far as a pre-screening, and a pre-screening is basically a personal financial statement. It's going to be a soft pull that will not affect their credit score. It'll be some questions. Maybe we usually like to take anywhere from a half an hour to 45 minutes with a client to just go over some basics, how it's going to affect their budget, what the payment terms would look like, and what the bank would be looking for if we decide to go through SBA. If it's going to be a rollover, what's accessible. When I say rollover, I'm talking about using retirement funds. What's accessible, how long it's going to take, and what the process is. That's what we usually do.
All right. So it sounds pretty painless, right? The 30, 45-minute conversation, typically, at least with your services, no charge to do that pre-screening. And that helps a person who's serious about business ownership to get a clear sense of what their financial reach is. That helps them set the guardrails for their investment, and they can speak to franchisors with confidence, knowing they're only looking at things they're qualified and able to target. All right. So you've mentioned a number of funding options so far, and I'd like to just dive into those a little bit. You mentioned SBA loans, you talked about retirement funds. Could you talk about some of these strategies and what are some of the benefits that these different things have, these different funding options have that people may overlook?
I think the biggest thing when we're talking about SBA loans, there's different types of SBA loans, and ones are suited for some, are not suited for others. The other thing is not all banks work with different all of the SBA options. For example, some banks will only work for SBA when it involves over a loan over 500. Other ones won't do a loan unless it's in a range of 50 to 150,000. The rules are different. And that's a lot of the things that we cover with the clients. If there's going to be a build out involved, is it going to be where you're going to be purchasing property? Or is this going to be a home based business? These are all the things that we discuss and educate a client on and what they need to prepare for it. One thing I can tell you is, it's very much like corporate America when you're working with a bank and SBAs. The more stuff you have prepared for them, the quicker it moves and your file doesn't go into the circular file. So we try to get everything done for the bank and expedite it. And really, one of the other things is not all banks process a loan. So they might take the loan application and they may farm it out to another bank or to a corporate office. Very important. We only work with banks that actually fund the loans from those locations, and we work with decision makers. So that's a timeline thing.
Quick follow-up, I think, on SBA. People who are listening to this may be in all sorts of familiarity, right? They may not know anything about the SBA loans. Some people are probably very savvy when it comes to the funding options. But in a nutshell, Small Business Administration, are they providing funding themselves? What are they actually doing? What is an SBA loan?
That's a fantastic question. It is the banks that actually fund the loan. They have to be on the SBA preferred lending list as well.
Okay.
The SBA backs up the bank. So should somebody default, in other words, I probably shouldn't say it, but I'm going to say it. The banks are not our friends. They're just a partner in business. So for them to feel comfortable, the SBA program actually says if you meet these SBA requirements along with your own banking requirements, and if the person takes on the loan and if they were to default on the loan, the bank isn't on the hook for all of the owed money. What it's saying is the SBA will reimburse the bank, and then the individual is now responsible to the SBA for repayment if they can, and the same thing to the bank. That is the important thing. That's what makes the bank feel comfortable, because otherwise the terms would be so much higher. I mean, why would a bank give you 150, 200, 300,000 without taking some type of collateral or making sure? It would be so strict, nobody would get banking loans, for business.
Okay, no, that's very, very helpful. So SBA makes it possible for banks to be more comfortable to lend to more businesses who are getting started. So that's why a lot of people, when they need funding, they'll go to the SBA backed loans. Is that fair?
Yes, that is fair. To follow up on that, it is the same for everybody. Since it is a government loan, it isn't like where, well, I've got super great credit and I've got this or that or whatever, I'm going to get better terms. It is the same for everybody. So that's important to know as well.
Why wouldn't somebody just go to their local corner bank if they wanted to get some funding for their business? If they maybe have a banking relationship for many years at the corner bank, isn't that a better way to do it?
That comes up a lot, actually. But the answer to that is goes back to the original statement. They may not actually fund the loan from that location. They may not be on the preferred SBA list. You need to know what type of industries they like to lend to. They have their own policies. There is a few rare circumstances where that is an advantage. And I mean, it's rare. Most often not, you really want to deal with a bank that specializes in SBA loans that are business friendly. So each bank has specialties.
Okay. So a funding expert like yourself who has access to multiple banks for multiple industries under multiple scenarios, that's really the advantage of working with a funding provider like you, as opposed to just putting all your eggs in one bank basket. Is that accurate?
That's accurate, as well as, having that personal relationship with a decision maker and what they're looking for. is going to give you a competitive advantage as a borrower compared to going into it blind and saying, I don't know what this bank's terms and policies are.
Oh, very good. That's a good call out. So now let's step beyond SBA loans for a minute. This idea of rollovers for business startups and using retirement funds. How can a person leverage their retirement to start a business? We know, American savings accounts are at all-time lows, but retirement accounts are where a lot of people's money are. So talk to us a little bit about that.
A couple of things. The first thing I would tell you is when we're talking to a client, we've always been indoctrinated, set it and forget it. Put your money in here, you're going to be a multimillionaire for many, many years. Don't worry about it. Well, a lot of things have affected that over the years. We could talk about recessions, we could talk about COVID, all different types of things will affect that. So it goes up and down. But what a person could do if they have funds that are non-Roth, traditional IRA or 401k, not with a current employer, is they could actually build a business as part of a new retirement plan for their business where they're allowed to have the business held within their retirement account. Money is transferred over from one to the other, and that still allows them to contribute just like they were working in corporate America up to the maximum. And they can do stocks, bonds, mutual funds, gold, silver, whatever they want held in there along with their business. And this is what we explain to people. Once that money is moved over in there, and then there is a transfer into the business checking account, which is set up with a tax ID number, now they own the 401k, they own the business, and they become an employee of that business. Now, some people will say, well, that's one way to get funded a business. Well, that's great. But this is really a retirement strategy and a saving strategy as well as a tax strategy. Getting into the weeds a little bit here, but in a nutshell, it allows them to save, contribute, match, and then when they retire, protect from capital gains by moving that money back into their 401k or for the business. And now they're only taxed on what they draw out. So they can continue to grow their business, buy other businesses. It's part of a growth strategy within a 401k account.
Okay, so yeah, this is definitely, that particular approach is much bigger than just getting startup capital so that you can fund your business. There's a lot of other advantages that you'd want to make sure that they speak to a qualified professional on to make sure that's planned and set appropriately. But what a terrific set of options there to not only get money for your business, but also to help you plan for retirement and optimize your outcomes later in life as well. That's pretty exciting.
And it can be used in combination with other strategies like SBA or a term loan or HELOC or whatever the case may be. So sometimes there's just not one path to getting funded. There might be several paths. And that's really what we do is we talk about all of those paths.
Mm-hmm. So typically a multi-pronged strategy then to get your business funded. It's not that you're just going to take out the maximum of your home equity and use that to start a business, or take all of your retirement to start a business, or put everything on an SBA loan. There's a lot of ways to lay different parts of this over each other to get the amount of capital you need. All right. I think you were telling me about the, when it comes to the number one reason that businesses are failing, isn't that related to capitalization? Can you talk a little bit about why this is such an important thing to think through?
Yeah, I think a lot of times, and I think, good savvy shoppers are saying, what can I get into this for? And you don't, use a cliche, you don't know what you don't know. And we always advise being properly capitalized, overcapitalized in some cases. It's not going to make that much of a difference on the payment, but it gives you that warm and fuzzy feeling to say, I've got plenty of money. And if I run into something I didn't foresee, things happen, life happens, business happens. You have that little extra because you can always pay that back, pay that down. And it's better to have it because if you get a loan, specifically an SBA loan, it's very difficult to go back to the bank and say, I didn't get enough money. In most cases, you're not going to be able to do that for the first couple of years. The banks are saying, well, you know what? This is what you planned for. This is what you turned in. This is what you said it is. These unforeseen costs, poor planning. It doesn't reflect positively, and it's very difficult to get money. So we tell clients, let's look at this, let's do some good validation calls, through someone like yourself, helping them and guiding them and saying, make sure you talk to top performers in similar markets to yours, get their experience, ask those right questions, going back to what you do, and say, now you have a pretty good feel for what it is, and now let's get a little bit extra just to be sure.
What are some common mistakes that first-time franchisees make when it comes to funding, and how can they avoid them? I think you've alluded to some of these, but
Yeah, I think so. Proper capitalization is one. Cutting corners is another. Not paying attention or budgeting enough for marketing so they can get the exposure they need, I think are three of the biggest things. Spending too much money out of pocket. As I just mentioned earlier, it's better to hang on to your money because get that business up and going and cash flowing before you start thinking about, you know, using all your money because if you don't need it, again, you can go pay it back. But it's nice to know that it's sitting there, things are going according to Hoyle, and you're good. And if they're not, you've got that money to go draw on. You don't have to ask anybody. It's your money. You go down there, you grab it, you're good to go.
all right, good. So making sure, it sounds like the common theme there is make sure you have enough capital to account for all the most important things during that startup phase, some of the unforeseen things, but making sure you have enough money for marketing. You mentioned shortcuts. A mistake that some people make is shortcuts. What are some examples of shortcuts that you're referring to?
Well, a couple shortcuts are in specifically is I say, okay, I got enough money to open and run a business. A lot of people don't think about, their growth strategy. And one of the things that I've seen come up that people really didn't plan for is what if you get an opportunity to buy out a competitor? I mean,
Mhm.
you're taking over somebody's business, you're taking over their client base. Make sure you have that money available. Make sure you're properly capitalized for growth. Other shortcuts people take, they'll look for any way to save a buck. And when you're starting a business, and I've owned several of them, and still own a couple of them, is look to say, look, I want a plan for worst case scenario and certainly for best case scenario. And those shortcuts don't mean, well, I'm going to try to save money initially. You're starting a business, you're not in it for 10 days, you're not into it for 10 weeks. You're going to be into it 10 years, maybe 20 years. And prepare to say by year 3, are you going to grow or are you going to go? Are you in a position to sell, recover your money, or are you in a position to grow and expand that business, buy another territory? That's some of the things that we talk about them, and those are shortcuts that people don't think. Initially, they kind of get blinders on thinking just about getting funded for that first opportunity, but it's a shortcut is, by not planning for grow or go, and then where am I going to be? Where's my exit strategy when I want to leave?
Yeah, Al, that's a really good point, and I think that's something that myself, my colleagues, and peers need to really help our clients work through as well, because like you said, sometimes it's just we're excited to get a concept open, get something started, see how it goes, and then decide what growth might look like. It's better to think about, hey, if this goes well, planning for if this goes well, do I want to own the territory, the region? Do I want multiple locations? Do I want to build an empire out of this? When would I want to sell this? Right? Those are some really important questions, especially since they have implications in those funding decisions they're making with you. So I really like that. Thank you for sharing that. I guess wrapping things up here, closing question for you, Al. If someone is listening, they're excited about business ownership, but they're a little nervous about this money, the money side of things, what advice would you give them as they take their first steps into figuring out how to capitalize their business?
Well, I think the biggest thing is to be open, with a funding source. You're going to need to be because you don't want to find out down the road. And the other thing is like, how is this going to affect my everyday, my lifestyle, what I'm used to or whatever? What is going to be my timeline commitment into this to make it successful? And from a funding perspective, do I have enough money that say, if that starts to impact that I might be able to bring someone on to assist? Maybe it's going to be a manager or a director, whatever the case may be. Maybe it might even be a partner that you have to do that. So you have to think about, what's going to be the employee costs, if you need to have that, your time constrictions, and having enough capitalization. I think those are the things you really got to look for and think about.
Very good. Al, again, thank you so much for taking time with me today. I know you're very busy. You got a lot of meetings going on, lots of clients all around the country. So thank you for sharing some of your insights with our audience here today. And for everyone else, who's listening, thank you for your time and attention. Al is more than willing to work with anyone who's starting their business ownership journey. So we're excited to make the connection. If you'd like to work with Al, let me know and I can make an introduction. Thank you.
Thank you.